Have you ever wondered why some investors seem to consistently grow their wealth while others struggle to get returns? It's not just about what the wealthy invest in, but also about what they deliberately avoid. Hello, and welcome back to Money Motivated, your go-to channel for unlocking the secrets of smart investing. Today, we're diving into a topic that's crucial yet often overlooked: what the rich will never invest in. Understanding this can be a game changer for your investment strategy. The world of investing is littered with options and opportunities, but not all of them are gold mines. In fact, some are pitfalls that the savvy investor knows to steer clear of. In this video, we'll uncover the 8 types of investments that the wealthy avoid like the plague. These insights are gleaned from the habits and principles of some of the most successful investors like Warren Buffett and Ray Dalio. So if you're looking to build a portfolio that thrives in the long term, stay tuned as we reveal these critical investment no-goes. Let's get started on unraveling the mysteries of wise investment choices. Number 1. Get-rich-quick schemes. The allure of get-rich-quick schemes is undeniable. They promise massive returns in a short time, often with minimal effort. However, the rich know that true wealth is not built overnight. These schemes, which range from multi-level marketing plans to dubious investment opportunities, are often riddled with risks and lack transparency. The wealthy understand that such ventures are more about speculation than genuine investment. They appreciate that real wealth is built through consistent, long-term strategies that focus on compound growth and value creation. Warren Buffett, one of the most successful investors of all time, famously said, "If it sounds too good to be true, it probably is." He and other savvy investors avoid these schemes because they understand that sustainable wealth is built on solid foundations, not on the unstable grounds of quick and risky gains. The rich focus on investments that offer realistic returns and are backed by sound business models. They value due diligence and thorough research over the seductive lure of immediate riches. By shunning get-rich-quick schemes and focusing on long-term, value-driven investments, they ensure their wealth is not only preserved, but also has the potential to grow steadily over time. Number 2. Trending or hyped investments. The wealthy are often wary of investments that gain sudden popularity or are surrounded by media hype. These include trending stocks, speculative cryptocurrencies, or any asset class that becomes a sensation overnight. The reason for their caution is simple. Hype can inflate the value of an investment beyond its fundamental worth, leading to an inevitable correction or crash. Seasoned investors like Warren Buffett and Charlie Munger have long advocated for investing in what you know and understand, rather than being swayed by the latest fads. They focus on the long-term potential of an investment, assessing its intrinsic value and the sustainability of its underlying business model. The rich are aware that the media frenzy around an investment often signals excessive speculation, not a sound investment opportunity. They prefer to rely on thorough analysis and their understanding of market dynamics rather than jumping on the bandwagon of the latest investment trend. This approach helps them avoid the pitfalls of market volatility and ensures their investment decisions are based on solid, well-reasoned fundamentals, aligning with a long-term strategy aimed at steady and sustainable wealth accumulation. Number 3. Non-diversified portfolios. The wealthy know that putting all their eggs in one basket is a risky strategy. Non-diversified portfolios, where a significant portion of wealth is concentrated in a single investment or a narrow range of assets, are susceptible to high volatility and potential loss. The rich understand that market fluctuations can greatly affect specific sectors or individual investments. By diversifying their portfolio across different asset classes, industries, and geographies, they mitigate these risks. Diversification isn't just about having a variety of investments. It's about choosing assets that react differently to the same economic event. This strategy reduces the impact of poor performance in any single investment. For instance, while stocks may suffer during an economic downturn, bonds or other defensive assets might hold their value or even appreciate. This approach reflects the wisdom of legendary investors like Ray Dalio, who emphasizes the importance of a well-balanced, diversified portfolio to withstand market shocks and economic cycles. The rich also regularly review and rebalance their portfolios to maintain this diversification, adjusting their investments in response to changing market conditions and personal financial goals. This disciplined approach to diversification ensures a more stable and resilient investment strategy, essential for long-term wealth preservation and growth. Number 4. High-debt companies. Investing in companies with excessive debt is something the wealthy typically avoid. High levels of debt can cripple a company's financial health, reducing its ability to invest in growth opportunities and making it vulnerable during economic downturns. The rich prefer to invest in companies with strong balance sheets, which include healthy cash reserves and manageable debt levels. This financial stability suggests a company's resilience in facing market fluctuations and economic challenges. They understand that companies with high debt might offer higher returns during good times, but these returns come with increased risk. If a company is over-leveraged, even a small decrease in earnings can lead to significant financial strain, affecting its stock price and dividends. Experienced investors like Warren Buffett assess a company's debt-to-equity ratio, interest coverage ratio, and other financial metrics to gauge its debt management. They prefer companies that use debt strategically, not excessively, ensuring long-term financial sustainability. This cautious approach to investing in high-debt companies reflects a fundamental principle of wealth accumulation, protecting capital by avoiding unnecessary risks. By focusing on financially healthy companies, the wealthy ensure their investments are not only profitable, but also secure, aligning with their overarching goal of long-term wealth preservation and growth. Number 5. Investments they don't understand. The rich steadfastly adhere to the principle of not investing in things they don't understand, regardless of how promising the opportunity may seem. This approach, famously championed by Warren Buffett, is based on the belief that a deep understanding of an investment is crucial for assessing its potential risks and rewards. The wealthy recognize that every investment carries its own set of complexities and market dynamics. Without a clear understanding of these factors, it's challenging to make informed decisions or to anticipate how different market scenarios might impact the investment. This lack of understanding can lead to misjudging the value of an asset, overlooking potential risks, or failing to exit the investment at the right time. Consequently, the rich prefer to invest in industries and assets they are familiar with or have taken the time to thoroughly research and understand. They also value the expertise of trusted financial advisors who can provide insights into areas outside their knowledge base. By investing only in what they know, the wealthy minimize the chances of unpleasant surprises and are better positioned to manage their investments proactively. This disciplined approach ensures their investment decisions are grounded in knowledge and insight, forming a cornerstone of their strategy for wealth preservation and growth. Number 6. Investments lacking long-term potential. Wealthy investors typically avoid putting their money into assets that lack long-term growth potential. They understand that true wealth accumulation comes from investments that not only grow in value, but also have the resilience to withstand economic fluctuations and market trends over an extended period. This preference stems from a strategic focus on sustainability and compound growth, rather than short-lived or speculative gains. The rich look for investments with a solid foundation, such as companies with strong business models, a history of steady earnings growth, and the potential to adapt and thrive in changing market conditions. They are wary of industries or assets that might be thriving currently but do not have a clear path to long-term success or are susceptible to rapid obsolescence or regulatory changes. Successful investors like Warren Buffett and Charlie Munger have long favored investment companies with a moat, a competitive advantage that can sustain growth and profitability over time. They also consider the broader economic and industry trends, assessing how these might influence the long-term prospects of their investments. By focusing on long-term potential, the wealthy ensure their investments are not just profitable in the short term, but also contribute to sustained wealth creation and financial security in the future. Number 7. Speculative ventures. Affluent investors are typically cautious about placing their capital in speculative ventures. These are investments with a high degree of uncertainty, often dependent on market whims or unproven technologies. While the potential for high returns can be tempting, the risk of substantial losses is equally significant. The rich prefer to preserve their wealth rather than gamble it on uncertain outcomes. They understand that speculation is akin to betting, where success is more a matter of luck than strategic planning. This cautious stance doesn't mean avoiding innovation or emerging markets altogether. Rather, it involves a balanced approach where such investments form only a small, manageable portion of a diversified portfolio. Wealthy investors like Warren Buffett prioritize investments with a solid track record and clear, understandable metrics over those based on hype or speculation. They also look for investments with tangible assets or a reliable cash flow, which provides some degree of security even in volatile markets. By steering clear of highly speculative ventures, affluent investors protect their assets from unpredictable and potentially severe market downturns, ensuring a more stable and reliable growth of their wealth over time. Number 8. Investments with poor management teams. Investments in companies with poor or unproven management teams are generally avoided by wealthy individuals. They recognize that strong leadership is a critical driver of a company's success and, by extension, its investment value. The rich invest in management just as much as they do in the company itself, understanding that even the best business model can falter under weak leadership. They look for management teams with a track record of sound decision-making, integrity, and the ability to navigate challenges. This includes evaluating the team's experience, their history of performance, and their vision for the company's future. Successful investors like Warren Buffett place great emphasis on the quality and capability of a company's leadership, often citing it as a key factor in their investment decisions. They avoid companies where the management is known for poor strategic decisions, lack of transparency, or unethical practices. In investing in a company with a competent and trustworthy management team provides a level of confidence that the business is in good hands, increasing the likelihood of consistent growth and profitability. This focus on strong leadership helps the wealthy ensure that their investments are managed effectively, contributing to the overall health and growth of their portfolio. As we conclude our exploration of the 8 things the rich will never invest in, it's important to reflect on the underlying principles that guide these decisions. The journey to wealth is as much about avoiding pitfalls as it is about seizing opportunities. The strategies employed by the wealthy are not just about preserving capital. They represent a mindset geared towards sustainable growth, risk management, and informed decision making. Remember, the path to financial success is not paved with shortcuts or swayed by fleeting trends. It requires a disciplined approach, a deep understanding of investment principles, and a commitment to long-term objectives. The insights we've discussed today shed light on how the affluent protect and grow their wealth. They emphasize the importance of due diligence, understanding the nature of your investments, and being cautious of high-risk ventures. This video is more than just a list of what not to invest in. It's a roadmap for thoughtful investment. I encourage you to take these lessons to heart. Apply them to your investment strategy to navigate the complex world of finance with greater confidence and clarity. Thank you for joining me on this insightful journey. If you found this video insightful, please like, share, and subscribe for more content. Let's continue to learn, grow, and make smart financial choices together.